4 o'clock sharp, so I am going to get going. So first I'll do a few introductions and give you some of the logistics of how the meeting works today. So first, welcome to LeAnn Riley's Real Estate Investing Club. And hi, everybody. I interview expert speakers and leaders in the real estate investing world nationally. And you can ask questions and participate from anywhere. And that's what's great. Could be from New Zealand. The truth is, you don't need a ton of money or knowledge to get started as a real estate investor. You just need to know the right formulas, and you need to follow a system to be a smart investor. So I'm LeAnn Riley. I'm a broker and a real estate coach, and I lead the Encore investment team of realtors here in the Twin Cities, Minnesota. And I built a multi-million-dollar portfolio in residential, multifamily, condo development, commercial, and vacation properties. As a national coach and trainer, I help ambitious people build wealth as real estate investors with my proven profit formula coaching program. And I provide free education like today with my real estate investing club. And I'm so glad you're here with us to discuss syndication. And I just want to remind you, check out my YouTube channel because my past webinars are all on my LeAnn Riley channel. That's more free education. So today the topic, syndication. What is it and how do I do it? And now I want to introduce our guest today. And this is Megan Lamke, and she is general partner in her own real estate syndication. And Megan and her husband, Derek, committed to becoming debt-free. And ultimately, they built a rapidly growing co-syndicated portfolio of over 2,225 units. That's a lot, you guys. Valued at over $500 million. That's some big bucks too. So I am really excited to talk to her. One more thing, she's the leader of the Real Estate Invest Her chapter of Minneapolis. So yay to women in real estate. Right, Megan?
Yes, thank you so much for having me today, LeAnn. It's been a pleasure interacting with you and all of the real estate circles, and it's just been fun getting to know you as a colleague and a friend.
Cool. So let's learn how investors pool their money to buy larger properties, multifamily and commercial, from Megan. So I'm really glad you're our guest today. And first, I always like to share, how did I meet our speakers? Because guess what? Real estate investing is about networking. And Megan and I first met about 3 years ago at a conference for real estate investors. And I watched her grow and expand into the multifamily syndications. And I was always curious. So I was snooping on her one day and I'm like, hey, she's come a long way. Let's have a chat with her. So Megan, give us a background about what led you to real estate in the first place.
Yeah. Well, I came from really humble beginnings, and our family actually declared bankruptcy when I was in elementary school, middle school, and that really left an impression on me. So I started picking up books like Rich Dad, Poor Dad and Cash Flow Quadrant as a preteen and a teenager. And so I knew that someday I wanted to go into real estate and create passive income for myself and my family to make sure that I wasn't repeating some of the same financial side steps that my parents had. So fast forward, graduated college, started working for Wells Fargo Home Mortgage during the refinance boom, AKA the recession, and met a lot of real estate investors there and just asked them how they built their portfolios and what they were doing different to be successful during a recession. And they were buying a lot. Fast forward, continued to network, continued to grow. My husband and I, like you said, LeAnn, we prioritize getting all the way out of debt, paying off our ridiculous student loans and our mortgage, and then sold our house and used those profits to invest in syndications. So that's really how I got started, was getting a job in the banking industry to understand and put myself in front of people in the real estate industry, and getting out of debt so that I would have capital to start investing and networking with like-minded people who were investing already that could point me in the right direction.
Well, and what I heard you say too, though, somehow at a young age, you got a hold of the Rich Dad, Poor Dad book, and you got to see that there was a different story about money you could have.
Exactly. Yeah. In high school, I was dreaming about, okay, how in the world do I buy red hotels instead of greenhouses? And what is that going to look like? And what should we do? And like when my husband and I met, explained that methodology to him, and we bought our first house and convinced our rugby teammates to live with us and did house hacking and burring. And all of that played into us changing our balance sheet for our finances so that we could become investors faster.
And I appreciate what you say. It didn't happen magically, and you didn't inherit a bunch of money. You put in some hard work there at the beginning, and then, and studying all along, and then you were able to apply your nest egg to something that worked.
Right. Yep. And
I really like that. Okay, now before we go on, I have a couple of logistics. I just want you folks here to know that first I'm going to take a poll here so Megan and I know who's listening so we can really address it to you. So I'm going to put up this poll. It's pretty easy. Can you guys see it? Can you see it, Megan?
I can.
There, somebody's voting. This gives, just vote on what type of real estate investing interests you. We want to see who's here, because guess what? There's 10, maybe 15, maybe 20 real estate strategies. And we'd like to see what's going on for people. There's people voting now. Oh, buy and hold is winning right this minute. This is kind of like a race. And I'll just give you, 10 more seconds to vote. So here's, for anybody who can't see this, it's how to get started. Are you a fix and flipper, wholesaler, buy and hold, syndication, house hacking, burr, realtor, scaling a portfolio is off the bottom. I can't see it. Okay, it looks like the winner is buy and hold. Here, I'm going to show you share results. There you go, everybody. We have a lot of buy and hold people, and people are curious about syndication. But I love this. See, it's a whole realm of different people doing different strategies in real estate investing. The only other logistic I have here is I want to share. Over there is the chat box, and that's where you would want to put a question so that while we're chatting, if you have a question, both Megan and I are looking there, then we can answer it. Okay, now here we go. So Megan, we really have to start at the basics. So in a nutshell, what is syndication?
Great. So a syndication is when a group of individuals pull together financial resources and decide to make a financial decision to acquire an asset together. Another way to think about this is you're simply gathering up all of your money with your friends and family, and you're saying, let's go buy an apartment building together, structure a corporation, and we all own shares of that corporation.
Okay, so it's a party. It's a group of people with the same mission.
Right. Yeah.
But somebody's in charge of that group, right?
Yes. So typically there's two groups of people that are involved in syndications. There's the general partners, which handle all of the day-to-day operations. They manage the property managers, they manage the asset. They make sure everything's performing. They handle all of the nuts and bolts and projections and K1s and financial details and do all of the heavy lifting. Then the other side of the partnership is the limited partners. And those individuals are the people who contribute capital but that's the extent of their involvement. General partners can contribute capital too, but limited partners are solely passive, is the phrase that we use. It's a passive investment, meaning you apply your funds and then you watch the business plan be executed.
And do syndications, is it multifamily or office or medical, or it's any kind of commercial or is it anything? Do people syndicate a bunch of airplanes, or, I mean, I'm just curious.
I mean, I'm sure you could. I haven't looked at a business plan of syndicating airplanes, just to be really honest, because that's not the niche I play in. But people can syndicate storage facilities. They can syndicate mobile home parks. They can syndicate office buildings or retail buildings or industrial plazas, multifamily housing apartments. You can syndicate a whole bunch of different types of assets. Syndication is simply the tool at which you're combining funds to come to the table to purchase an asset.
Okay, and I see somebody says property first or money first. Good question.
Great question. I think it really depends. It really depends on you and your experience and where your strengths lie. So one tactic is to go create a pitch deck and say, here's what I'm targeting friends and family and accredited investors. This is the type of asset I'm going for. If I found something like this, what would be your soft commitment amount? And write down all of those numbers, track them in a content resource management system or a CRM like ActiveCampaign or Salesforce, and build a pipeline. Another way is to go find a property and then go talk to all of your friends and family, and hopefully everyone is willing and able to go along with you on the journey of syndication, and they'll wire funds within the 30 to 60 days of when you need them. It's my experience that you want to be having those business level investor conversations first, and it's more effective to build a marketing platform and a content platform and an investor relations platform so that you can scale and grow more efficiently. Both plans have worked, but in my experience, you need to talk to investors first.
Yes, because if you find the property and you need $10 million and you only know 6 people that are in, then you have a gap, or something. I totally agree.
And so there's this idea of having the law of the first property. So when you're applying for financing with either a local lender or Fannie and Freddie, you've never done this before, they want to see where the money is coming from. So if you can say, here are my Rolodex of soft commits from friends and family and accredited investors, it makes your offer stronger. And it helps you build that business relationship that you need with lenders.
Yes, it is all about the lender, isn't it?
It is. It is. Because
the property and the lender got to work.
Right. If you can't prove that you have the assets and the finances to be able to sign the dotted line at closing, no one's going to lend you a loan to close on that property. And you won't be able to close if you can't raise the capital you need for the down payment.
And you nailed it, especially today, here we are in 2021, and we're talking about a tough market, and it's tough in the multifamily sector. I don't care where you are. There's a lot of people wanting these properties. So you better have your ducks in a row, right down to the duplex here in town or all the way to the big kahuna, right?
Yep. It just helps you be a more strategic buyer.
Yeah.
When the financing is a simply check in the box versus this strategic negotiation that you need to go through. I know there's a lot of options for seller financing, but I'm not seeing that in the markets that we're playing in.
They don't have to anymore.
Yeah.
One great question over here is, how is a syndication different from a REIT, a real estate investment trust, is what I'm talking about.
Yeah, great question. I could probably talk about this for 3 hours, so I'm going to give it really high level. So a syndication can be a group of accredited or sophisticated investors. So you have your 506B, your 506C, Regulation D. A REIT, you're still pulling together financial resources. It's managed by a trust. However, because investors aren't limited partners, they're not at the partnership level, the pass through of the depreciation of the building doesn't benefit REIT participants. It only benefits syndication participants. So
There's a big one right there.
The biggest difference is that potential tax benefit. And again, here's your friendly disclosure. I am not a financial advisor. I'm not a CPA. I'm not a lawyer. You need to talk to those experienced professionals about your tax situation and legal situation. All I can speak from is my own personal experience and the experience of our investors.
Okay, and then I see one more question I want to hit right now. Who gets the loan then? The general partner?
Yep,
or the limited?
Nope, the general partners are signing on the loan, and you need to have assets that allow you to take out that size of a loan. So if you're getting a loan on a $10 million property, you better have assets that prove that you can take out a loan that big, because you're going to get underwritten not only on the building, but if it's your first time and you don't have that business relationship, the lender is really going to dive into your personal financial situation. That's not how they're underwriting the building and the performance and your business plan, but they need to know that you're not what we call in the industry is a bad actor. So
totally. Okay, now keep the questions coming over there, but I still want to ask you now, just in general, I'm going to ask her to teach us a few things first before we hit her with all the questions. So why would a person want to invest in a syndication? Like, what's the big benefits here?
The big benefits for my investors have been passive income. They receive tax benefits, especially when we're doing cost segregation, especially when they have a full-time real estate professional designation where they've acquired properties in the past or they've been a landlord in the past. That pass-through depreciation can help offset active losses, especially if you're a household where one person is working a W-2 job and the other person is a full-time real estate professional. It can really make a giant impact on your taxes. So that's the big difference. The big vision is, in many cases, there's a significant tax value in participating in syndications.
I would hope too that the return is potentially better than maybe you can do or equivalent, and you don't have to do the work.
Yeah, exactly. And again,
that's personal.
All depending on if you really love DIY, if you are the type of landlord that tenants and termites and toilets and crazy things in the middle of the night are your jam, cool. Syndications probably aren't for you. But if you just want to collect a monthly check and say, thank you so much for my distribution, and I'm excited to participate in the upside when you go through the cash out refinance or when you exit on this property, great. Syndications are probably a better fit for you.
Now, when I gave the introduction, you said you participated in co-syndicating. So now what's the difference? Co-syndicating and syndicating.
So it's a nuance. So general partnerships normally aren't just one person. It's not just Bobby Joe on the street being the only general partner. Normally, a general partnership, you have multiple people playing different roles. You have someone that's overseeing the asset manager, someone that's overseen as investor relations, someone that's overseen as acquisitions. And so that's where co-syndicating, I'm entering into a general partnership with experienced syndicators, experienced operators, and I'm a member of that general partnership team. So a synonym is co-syndicating.
Okay, got it. And I see here, how are assets chosen in a syndication?
Yeah, every business group has a different business plan that they're targeting. So there's different metropolitan areas that they're targeting. There's different asset classes that they're targeting. There's different returns, whether they're looking at a value add or they're just looking at correcting some mismanagement. It really depends on what your business strategy is, what your targets as far as returns are, and where you're looking to invest. So every business plan is different. I know in the areas that we focus in, Florida, North Carolina, South Carolina, Georgia, Texas, we've looked at Minnesota and Iowa. It really just depends where the money makes the most sense.
Sure.
You can make the best return with the MSA that you're targeting. So,
Okay, and do limited partners have voting rights or some
great
level of
question.
influence?
This is where it's different than a publicly traded corporation. So I'm guessing that's where the similarity is coming from. In a publicly traded corporation, you can have preferred stockholders and you can have common stockholders. They all have voting rights. However, in a syndication, it's different. The general partners manage the entire asset. The limited partners simply provide the capital and collect a return. They're not involved on the data.
You don't get to call them up and say, how's things going?
Yeah, you don't get to. Again, the general partners, their responsibility is to provide monthly or quarterly updates on the asset and the project and provide annual K1s so you can file your taxes. Some of the groups some of the assets that I've been a part of, we've created business groups where we poll our investors to say, hey, here's what we're thinking as far as a renovation for the windows or the color of the brick. Do you want to vote and cast your ballot? But it's not a formal opinion. It's we're going to paint the brick what we want the color of the brick to be. We want this to be fun for you, but we're still going to be able to choose the color of the brick at the end of the day, if that makes sense.
Yeah. And I have heard sometimes people go put their money in a syndication and they get irritated because there's no communication from where they put their money. And then they feel, a little nervous, right? Mm-hmm. But if there's communication, then you know what's going on. And it's not always perfect, just like any real estate deal. But if you're being let in on what's going on, it makes a difference. It's your money.
Yeah. Yep. So, and the best syndicators will send out monthly communication.
Absolutely.
At least a newsletter. And that's where we operate, is we're sending out at least a monthly newsletter to everyone who's invested with us.
So they know what's going on. What would you say is a precaution about investing in a syndication?
Yeah. So there's a couple of things that are red flags for me. And when I first started off as an investor with my husband, some of the things that really stood out to us were track record. So is this syndicator's first deal, their first time managing an asset, or have they done other work with colleagues and now they're branching out on their own? Do they have an established portfolio that they've managed already? Help me understand their track record and help me understand the performance on that track record was really big for me. Understanding if situations where things didn't go as projected, what did they do and how did they correct it? How did they still lean into the attention of, hey, our business plan needs to flank, but we're still making good on our promise to our investors? What did that look like? Were all red flags to me if investors didn't.
And how did you go about investigating these individuals or the companies? I mean, that stuff's not all on the internet.
No, it's not all on the internet. It takes time to have conversations with people. Most experienced syndicators will have some version of a club or an investing club on their website. You log on, you submit an application to join their club, and then you get to have a conversation with them about their business track record, about how they execute the business plan for their assets, and get a feel of, do you know, like, and trust them? And then you can go do your research at the Better Business Bureau, or you can use the Freedom of Information Act to look up the general partners and see, okay, do they meet any of the bad actor criteria that would make me feel apprehensive in giving my hard-earned money to them to manage? And so those are some of the tools that I looked at as an investor. And now that I'm on the other side of the coin as a general partner, I make sure that we uphold the integrity of all of those things that I was afraid of as an investor.
And I remember when I read your bio, or maybe when we talked before, you and your husband, you just like put a little in, see how it goes first, right?
We did. Yeah. And it's almost unheard of in the industry now. We really wanted that proof of concept first. So our very first syndication, we invested $5,000 and that was it. And like, because we were accredited investors, but we wanted to make sure that people did what they said they were going to do, and that we still got that check, we still got that communication every month. And that's why we offer a lower barrier to entry in our business, just to make sure that people can still have that proof of concept.
And I'm going to have you show us a little bit of this, but I got a couple other questions
Yeah,
first.
go for it.
You're the general partner. There's these 10 limited partners or whatever. Do I get to know them or who they are? Or, there's no like Zoom with all of us on there or anything like that?
No, there's no Zoom with all of them on there. You might meet them every now and then. We'll say, hey, we're going to fly out to look at this property and look at all the renovations. If you feel comfortable flying, come on out. We'll buy you lunch. You might meet other investors there, and networking happens organically. But no, we respect people's privacy, and we're not going to have you be a reference to.
Right. And we might not even know who they are.
Yeah.
Yeah. I get it. Okay. Because that's what I was wondering. What if there's a stick in the mud in the group that's causing issues? You've got your project going, you're doing all fine as the general, and there's this stick in the mud in the group hassling you. What do you do?
My question is the stick in the mud a limited partner or a general partner?
Limited. Yeah.
So if it's a limited partner, then you just turn on your customer service hat. You say, hey, you invested with us. We're meeting our fulfillment of the type of information we're giving to you. We're providing returns. We're managing the asset just like we said we were going to. Or if we had to deviate from our business plan, here's the reasons why, and here's what we're doing to make it right. But if someone's being a stick in mud and they're your customer, you turn on your customer service hat and you work through it. If someone's being a stick in the mud and they're a general partner with you and you're two general partners and you're having a business partnership disagreement, every single one of our syndications has been registered with the SEC. We have an SEC lawyer on retainer that has filed all the paperwork, and they help us with business partnership disputes should we ever need them. And they work as that mediation person.
Well, and I'm sure not all syndications are successful. This is like the stock market. You put your money there and something might happen, whatever. I mean, and so you do need to work with reputable people, but that doesn't always mean, it's not like, oh, I didn't like it, I get my money back. It's not like that.
Yeah, it's not a liquid investment.
Exactly.
So again, the business plans for most syndications are 3 to 10 years. So if you are looking for something that's more liquid, syndications aren't the best fit for you, and that's okay.
Mm-hmm. So that leads me to this next one where I think you can maybe show us how much money does it take to get in, and maybe tell us about your 3 categories.
Sure. So the 3 categories of investors that I work with are aspiring investors, sophisticated investors, and accredited investors. So starting at the lowest barrier to entry, aspiring investors. The way I categorize aspiring people are they probably have some debt. They haven't really invested before in the stock market or anywhere else. The type of avatar that I relate this to is someone who is still in college, someone who maybe went through a divorce or is a widower and just didn't save in the stock market, and they really need to build up that emergency fund first and start investing. So that's aspiring. Sophisticated is the type of investor who has a fully funded emergency fund. They've been investing in the stock market or in real estate for at least 2 years. There's some income threshold requirements. So they're making over 6 figures, but not yet up to the accredited investor level. And they are hungry for knowledge, just like aspiring investors. But they've been around the block a little bit and understand some of the nuances when it comes to investing in real estate and syndications. Then there's accredited investors. So these people are making over $200,000 as an individual, over $300,000 as a couple, and their net worth is over $1 million, excluding their primary residence. So many times these are business professionals, they're doctors, they're technology professionals, they're real estate professionals, or anyone in sales who's crushing their quota and hitting President's Club. Anyone who has a booming residential or commercial real estate portfolio already are most likely accredited investors. And there's some additional definitions of accredited investors that the SEC has released as of August in 2020. So if you want more information about that, I can make sure to add the link in this on Facebook afterwards. But if you have trouble sleeping at night and want to read all of those, I'll send it to you.
And then you'll fall asleep. Okay, great. So there's these 3 categories. And when you spoke before about you started at $5,000, you were down there in the aspiring investors in some sort of a crowdfunding, something to be able to just put in $5,000.
Yep. So my husband and I, we were aspiring investors when we were $500,000 in debt. So we weren't investing in anything until we got out of debt. So we were making 6 figures a year each. We had the income, but we were drowning in debt. So we didn't start investing until we were sophisticated. All the way out of debt, we're making 6 figures each, and we're ready to start investing. So one of the things that I do, because I'm a licensed security representative with a broker dealer, is I need to make sure every single one of our investors go through a suitability requirement. So I'm not taking money from an accredited or from an aspiring investor if they only have $1,000 to their name, for example. I'm still happy to provide training and help you coach and help you figure out creative ways to save money and teach you about syndication so that someday you can invest $5,000 in a syndication, for example. But I need to make sure that I'm guiding you along a path and not taking your emergency fund, for example.
And don't all syndicators need to be licensed because this is a SEC purchase?
So here's the difference. Many syndicators will register their offering with the SEC.
Okay.
And that happens through Regulation D of either a 506C or a 506B offering. And you'll have an attorney draft that, and then you can make your offering into a private placement memorandum and share it with either your friends and family if it's a 506B, or publicly if it's a 506C, as in Charlie. There are some individuals like myself who have seen the writings on the wall, have lived through SEC audits and what it did to the industry in 2020, and have said, hey, we should get our license as a securities representative, and have taken exams and taken steps towards becoming that licensed individual. So there's a series of exams that not every syndicator has taken. And I wanted to do that as a way to differentiate myself and to provide better service to our investors.
Cool. Okay, so now you have a case study, and I think we would love to see, just kind of walk us through something here, and let's see, we'll get some questions and I'll ask them while she's walking us through.
Sure. So before I show a case study, I need to show all of the disclaimer information. Just 1 minute. All right. So here's the disclaimer. This is, again, a case study of something that I worked on in 2020. Worked collaboratively with the DeGrossa Group, who are amazing friends of mine. Here's this. It is not a public offering. All of this information is not a solicitation, is basically what that means. So
And
there
this
is
already done and over. It's
already done and over with.
study. Okay, perfect.
That is our disclaimer. And now I'll go ahead and bring up the visual example of this. So just to kind of set the stage, this was a 506C as in Charlie offering. And what that means, again, is it was for
I can't see it yet. Do you?
Yep, I'm just pulling it up.
Okay.
Yep, I'm trying to set the stage a little bit. So it was a 506C offering in Winston-Salem, North Carolina, 336 units. And it was a 506C, so for accredited investors only. So here were some of the projections that we shared. So some of the things that we talked about today were that there's limited partners and that there are general partners. Let me just zoom on up. So this is what we talked about, how there's a general partnership, there's limited partners, and then there is the debt. So debt clearly breaks out the partnership between here's the people who are managing the asset, here's people who are solely providing funds and resources, and here's where we're getting the debt. In this group, there was a 30-70 split between general partners and limited partners.
And they came up with 10,000,008 on there.
Yep. So for the equity that we raised, 10.8 million. Yep.
Okay, so in that, and now you have a limited partner A and a limited partner B. There's two kinds.
We do. Yes. Just to add an additional complexity to this. So just like in corporations where there's preferred stock and common stock, we have limited partner A and limited partner B. So in this opportunity, limited partner A was in line right behind our lender for the debt stack. They had preference. They had an 8% pref for an 8% return. Their business plan was we were going to hold those shares for 3 years, and then after 3 years they would exit. Whereas in contrast, Class B had a 6% pref, and we would hold those shares for 10 years, and they would get to participate in the upside of the asset as we look to refinance, do a cash out refinance, and as we look to exit the property in 10 years.
So it's interesting. Each of those in your case study here put in 50,000, but you could choose, am I going to put it in for 50 years and go for this higher return, or do I put it in for 3 years at this lesser return?
And some investors chose to diversify and say, okay, I'm going to put in
there.
And half in category A and half in category B. It really just depended on what the goals were for the investor. And that goes back to suitability and what makes the most sense for them in their individual term. Like, I'm not going to ever convince a 90-year-old accredited investor that they should put money in a 10-year investment. Like, that doesn't make sense. So that is kind of the two-tiered structure. It's super common in syndications to have that two-tiered structure now to help with diversification throughout the asset. And then the other example was just, what does this look like? Megan, help me understand, if I invest $100,000 and I'm a Class B limited partner, what does that mean? What do you project? And so we normally put in tables like this of, here's what $100,000 investment looks like. Here's what $1 million investment looks like, to make the math super simple. So you can see, okay, year one, we're projecting that there's going to be a 6.3% cash on cash return. So this is what you would see as far as cash flow. In year three, there'd be a refinance event. And then in year 10, there'd be an exit. So again, the projection is $100,000 investment in a Class B limited partner turns into just shy of $250,000
in 10 years, right?
Whereas Class A is that steady 8% return for 3 years, and then return of capital at that exit event.
I think I get it. I'm looking up at the top, return overview, where you have Class A limited partner. So then you averaged it out, and is that where you got the 8%?
Yep. So the average cash on cash return for Class A limited partner is actually consistent. It's 8%, but Class B is the variable. So you'll see in year one, it's 6.3, and year 10, it's 14, but the average is 11.95.
Yep. And and then the middle column is equity multiple. Explain that.
So the way that, so the way people think about equity multiple is how quickly is my money multiplying? How quickly is my money turning into more money? So the larger that number is, generally the better.
And then the last IRR means?
Yeah. So the way to think about IRR is, this is the compounding interest of all of the returns over the entire investment. So when you add up, this average cash on cash return is looking at the average of all of these, but IRR is looking at putting money in, and then what was your return on investment at the end of that 10-year.
Okay, got it.
I know that was a lot in the weeds, but sometimes it helps to see real numbers of a case study of what things looked like.
A lot of people are more visual. So now let's go to a few of these questions. Do we have to roll over our profits into a 1031 exchange or pay the capital gains?
Again, that is a great question for your CPA and your tax advisor. So I work with people who do 1031 exchanges of residential and commercial investment properties into multifamily syndications.
Absolutely.
But because you're receiving monthly dividends from a syndication investment, and then you receive return on capital at that exit event or that refinance event, many times you get to decide, is there another investment opportunity that you want to put that in? Or are you taking that and putting it in a tax shelter account? Again, I'm not a financial advisor. I'm not a CPA. Everyone's tax situation is different. I can just tell you what we've done and what we've helped our investors do.
From your case study, it looks like the typical time of holding a property is 10 years. Is that?
That was one example. Nope. Our typical is a 5-year hold. So normally we're looking at doing any sort of value add or increasing net operating income in the first 12 to 24 months, and then having either a refinance event at 24 to 36 months if needed, or just exiting at 5 years. So this plan was a little bit longer because of the location, knowing that in this area of Winston-Salem, they invested over $1 billion in revitalization in an area called the Innovation Quadrant. And we are planning on holding for a lot longer.
Okay, that's typical. Like you say, you get the asset repositioned, and then you do your value add and all that, then you stabilize it, and that's when you refi out of it, or
or you refinance and you pay
These people.
investors back a large portion of their investment, and then you continue to hold. It really just depends on what works best for the business plan you're trying to execute in the market you're trying to execute it in.
Well, and here's an interesting, one, are recorded financial statements posted for public review in this kind of thing?
They're not. These are all private placement memorandum. Yep, they're private placement memorandums. So what you can see is if certain syndicators have had violations with FINRA or with the SEC, but you're not able to see public financials because they're not public companies. They're private placements. You can ask for previous projections, or you can ask for previous business plans, but what you're going to get is that deck or that case study, like what I just showed you.
Well, and that's why we're back to networking, aren't we?
Yes.
Because networking, if you go, show up at certain events like we were at, you just run into the same people and you hear, I've been a realtor for a lot of years. I know who's maybe not operating up and up. And I also know who's you can always count on. You just know after a while, even if it's in another market, if you dig around enough, you figure out stuff.
Exactly. And it always comes back to who do you know, like, and trust? And a big part of that trust is the third-party validation from networking at events.
Yeah. This is a great question for a sophisticated investor income level. What about somebody that is retired and you don't have this darn W-2 anymore? How do you look at that in your categories?
I look at it as far as net worth. So again, my criteria for working with investors is a lot more detailed than most syndicators out there because I report directly to FINRA and have a broker dealer and all these additional regulations. So when I sit down with investors and go through a suitability questionnaire, we're talking about net worth and liquidity of assets. And that's where that comes into play. Most people when they're retired, depending on what their retirement number is and what they need as far as a lifestyle, their assets are generally over $1 million when they've paid off their house and have a nest egg. So. Okay.
And there's a question here, what's the hierarchy of payment for a failing syndication? Is it general partner, limited, it's.
Yep. So just my microphone, just to add a little bit of context, when 2008 hit, you can literally Google image, how well did multifamily syndicators do and how many times did they default on their loan? Because that would be an indication that the property is failing. So the debt stack for that, or when that happened, it was less than 1%, like 0.03% in 2008. So people who can qualify to be a syndicator don't typically default unless if there's something hugely catastrophic going on with the market or with the property, they didn't underwrite it well, or if they were just a bad actor. You're normally mitigating that risk before you go to purchase something. And then the other part of that question was what happens, who gets first? So the debt gets paid first. Whoever you took the loan from, Fannie Mae, Freddie Mac, whatever, they take it first. Then preferred investors, so that class A, then class B, that limited partner class B, that got to participate in the upside. And then if there's anything left, which if you're failing, you're defaulting on the mortgage, chances are there's not, then the general partner would get paid at the end of that.
So the general partner has skin in the game, as we say, in,
Yes.
their own skin in the game and their reputation and everything else.
Right. And most of the really experienced syndicators who have a lot of integrity invest alongside their limited partners, not just their time, but financially.
Yeah. Put your money where your
So
mouth is.
put your money where your mouth is. Yeah, we've done it. It's not, $2 million in every syndication. We're making sure though that we're investing in alongside our limited partners in every single syndication that we participate in.
Okay, good question here. You showed us the formula, and in 3 years we're going to refinance, let's say. And what if the interest rates go to hell, or something happens, and you're going to exit in 5, but now all of a sudden we're in some weird market crash? What happens then?
Yeah. Great question. So we mitigate all of those risks on the upfront for underwriting. And so we make sure that we're super conservative in our projections, in our business plan, in our underwriting to account for those variables and those margins. If the market isn't great for refinancing in 3 years, okay, we'll shop the rate. If it's better in 24 months instead of 36 months, great. We're constantly shopping the rate. We're constantly figuring out how much is this asset worth based on its NOI, based on the renovations that we've done to date, based on the stabilization that we've provided or the value that we've added. We have whole teams as far as the underwriting team and the asset management and the acquisitions team to handle all of those. And if needed, I started off going to school as an actuarial science person, so I can pull up my calculator and my Excel spreadsheet, start crunching some numbers with the best of them. But you don't need to do that. You delegate to people who are wonderful asset managers and are gifted at underwriting to help you.
Well, and as with any real estate investment, if the market is tanking, you just hold and you have those people continue to pay the rent. This is what I love about multifamily. They have to live somewhere, and you just hold through that down, and then you reposition when the time is right. You don't reposition right in the middle of it.
Mm-hmm.
Yeah.
Right. Yeah.
Okay.
So again, that's why it's all projection.
Yeah. So. Because we don't know, we can't project the future. That's for sure. And we've all learned that. Mm-hmm. So that does bring me to we're in a pandemic, and this eviction moratorium keeps getting extended. What as a general partner are you doing to handle this?
Yeah, great question. So here's been our ace in the hole. That's been a little bit different for our team is we decided to prioritize people and the relationships with our tenants and make sure that we're still making profit, but we're prioritizing that personal relationship. So we decided to educate our tenants on making a budget and providing them all with access to Dave Ramsey's Financial Peace University and the Ramsey Plus app, so that they learned how to budget with whatever financial resources they're getting, whether that's the monthly unemployment stimulus checks and bonuses, whether that's they're doing a side hustle now. We directed tenants to Upwork and Fervor and VIP Kid and other ways that they can legally make money online as an employee, as a contract worker, so that they're supplementing their income. And then once we've provided all of these resources, including things like here's nonprofit organizations that are giving away groceries, if they still can't make their budget work, we're saying, great, let's put you on a payment plan. And if they're unwilling to do all of those things, we have a tough conversation saying, are you unwilling or are you unable? Because if you're unable, hey, we have sympathy and empathy for you. We'll continue to help you work with churches who have resources to help pay rent or nonprofits. But if you're just unwilling and you're that bad apple, we're documenting everything and we can still go through an eviction process. Yeah. If we've provided you literally everything under the sun and you're unable to do that, and in many cases you're wreaking havoc on a property, then you're gone. Another program that we've done a couple of times is cash for keys. So, okay, we've given you all of the resources under the sun. Are you unwilling or are you unable to perform? Okay, you're unwilling. We're showing up with a locksmith. Get your stuff out. Here's 1 month worth of rent. Good luck. And changing the locks right then and there.
Yeah. So there is, and I 100% agree with you. I teach property management in my proven profit formula. And absolutely, this eviction moratorium shouldn't stop us if we know how to manage a piece of property.
Mm-hmm. Mm-hmm.
And from me looking at the stats, it's not that bad. People, there's money available to help people in so many ways, but we have to educate the tenants and lead them to the water. Okay. What is your husband's role in all this? I'm curious.
Yeah, Derek is this mathematical mind, and he is super gifted at finances and underwriting and managing assets and checkbooks. And he is very, very good at seeing all of the possible ways that we could execute a business plan and say, Megan, go do these 2 ways. You're going to be the most successful. So that's his role, but it's very, from a time standpoint, very minimal compared to me doing this full time. So we make a really great partnership.
He's still working his other job.
Yeah.
How long did it take you to get from, having all that debt to where you are today? How many years did that take?
Just under 5 years. So we paid off over $500,000 in under 5 years, 4 years and 11 months, 4 years and 10 months.
That's pretty cool. And how many units do you have right now, Megan?
Yeah, you shared it at the very beginning. We have just over 2,000 units, so 2,225 units valued at, $500 million plus and growing.
That's a lot of real estate. And thank God you're not doing it all by yourself. That's what
I'm not. I'm surrounded by wonderful people that continue to teach and educate me and are great partners. And I'm so thankful for them.
So now I want to ask you, you obviously work with lots of investors. What do you think is in store for 2021?
I think that in 2021, it's going to continue to be, what's a nice way to say this? Competitive as far as from a general partner standpoint. But I think there's going to be lots of opportunities for investors to continue to diversify their portfolio in multifamily investing. I think the stock market is going to continue to fluctuate. The bond market is going to continue to provide low returns. So people are looking for alternative investments that can actually keep up with inflation.
Totally. So, what's your biggest secret for those listening who just want to get started?
Yeah, I think the biggest thing that you can do, depending on how you want to get started, if you want to get started and leave your corporate job or stop doing all of your side hustles, just become a passive investor. Like, there is no shame in doing that. You simply reach out to syndicators, apply to be a part of their club, ask really great questions, and then start investing. If you're looking at becoming a general partner, I would highly recommend being a passive investor first, and being a passive investor for probably 12 months before you really understand, do you want to be in charge of the day-to-day asset management and property management and managing the property managers and going through and acquiring a property and underwriting and prospecting with brokers? Do you want to do that, or do you want more time freedom? So really diving into what your goal and what your purpose is, but reaching out to people who are successful in the industry and just genuinely building a relationship and asking questions for how you could provide value to them.
I love that. Somebody is saying, hey, I had to take a call from my realtor, so I missed the last 20 minutes. That was probably a hot property because you got to take the call when you can. But no worries, anybody. This is recorded. I'm going to share with you a couple things of how you can contact Megan. So I'm going to move over to a couple of things. First of all, of course, I have an offer. If you want to book a strategy session with me on buy, sell, invest, it's the Minnesota market. And remember, I have that team of realtors. You can go to my webpage, LeAnnRiley.com, and there's a button over there. It's easier. And, you know, these strategy sessions are just let's chat real estate. And you know, you guys, how I got to talk to Megan, I had to make a strategy session.
It's true. It's true.
Yeah, that's how it works. Okay, the other thing I have here is this is how you can contact Megan.
Yeah, the best way to reach me is just simply go to my website. In there, you'll find a way to connect with me. I look at that all the time, and you can actually book time on my calendar. That's the fastest and easiest way to get a hold of me. My virtual assistants handle all my emails. So if you need to reach me via email, you can email me. Otherwise, find me on LinkedIn, and I'll put all of those in the chat.
Okay, good. Great. Put those in the chat. And then you guys are here. Anybody live, you're in the LeAnn Riley Real Estate Investing Club. But if you're watching this on the replay on YouTube, this is where you go to join the club. It's free. If you join, you'll be notified about my speakers before they're live, so you can figure out if you want to be there. Okay, so I'm going to go off this. And Megan, did you put that in the chat?
I did.
Okay, good. We're good. There's her LinkedIn and her club info. I'll have my social media lady put that on the slide and on YouTube so they can figure out where to call. So I appreciate it so much, everybody who attended. It was really exciting to get it explained in English, Megan.
I'm so glad that I could help with that. Hopefully it was in plain.
Uh-oh, I can't hear you.
Oh, there we go.
There we go.
My microphone just decides that I wasn't talking fast enough. So thank you so much for having me. If you have any questions, or if I didn't get to a question that you have about syndication, I'm all about helping. So feel free to reach out to me and just let me know how I can answer your question.
All right. Thank you so much. And I know everybody got a lot out of it. So you'll be hearing from folks after I post this.
Perfect.
Thank you. And we'll meet up again.
Okay. Sounds great. Bye.
Bye.